In this video, traders, look at buying stocks in a bear market. Stay tuned. Hey traders, warm welcome to you. Okay, so question came in from subscriber. Appreciate the question. Now, there's two ways of looking at this question. One is buying stocks. The answer is buying stocks in a bear market. The other is buying generally in a bear market. So I'm going to do two videos for you guys. Make sure you check out the next one if you're looking about buying any market that's in a bear market, how you go about approaching that, how you time that. If we're looking about buying stocks in a bear market, I've got 1, 2, 3, 4, 5, 6 hints for buying stocks in a bear market. So assume if you're in a bear market, and a bear market is obviously a market that's heading down, whatever reason that may be, how do you go about buying stocks? Because we all know that the opportunities come when there's blood on the streets, but we also know that these things can run on and on for way longer than we expect. So how do we time the thing? How do we kind of navigate this? And how do we, take advantage of the opportunity that a bear market can bring? Now, I want to just say that in a bear market, by far the best thing to be doing if you're a trader is shorting things. Bear market presents huge opportunities for short-term traders, medium-term traders. Going short in a bear market and the right conditions is an excellent strategy. However, let's assume you're an investor. Let's assume that you don't want to do that. Let's assume this video, you want to buy some stuff to kind of get yourself a reasonable thing and tuck it away. Now, if you were not too bothered, you just pick some stocks, you'd buy them at some price, they come off the high, you tuck them away in the drawer, you'd have a look 5 to 10 years later, and hopefully you made some money. And if you go by history, unless your stock goes bust, you're probably going to be okay with that. I'm putting a big caveat out there. That's not always the case, but if you look at history, bear markets have always recovered because we're at all-time highs when I time to do this video. But if you want to time it a little bit better, if you want to kind of get a bit more juice out of it, get a bit of meat off the bone, then there's some ways that you might be able to finesse it without losing out. So the first one is to scale into positions. So for example, this is kind of self-explanatory really, isn't it? If you've got a stock that you really love and you've got, let's say, 100,000 to put to work, don't just buy 100,000 in one big batch. Say to yourself, you know what, I'm going to spread this batch over the next year. I'm going to do 10 grand a month over 10 months or whatever it may be, and I'm going to split it out. And then my average price, if the price keeps going lower, I'm still going to get a decent average price. If we reverse and happen to get the low, I'm still going to get a decent average price. It's not foolproof, of course, because it could just be getting started. It could be into a 5-year bear market or stagnation or whatever, or you could bounce and be buying in the year bounce and then goes into a further bear market. So there's no foolproof way, but at least it spreads your risk a little bit. Number 2, looking for dividend stocks. So this is a popular one with investors, looking for stocks that are paying decent dividends. Obviously, you need to make sure the company has got a good solid balance sheet. It's not going to go bust anytime soon. But bear market will highlight potential. If it's a good company, it's still making money. Perhaps they're not growing as much, but perhaps they're still generating decent cash flow and decent profits. They're paying a decent dividend, the yields all of a sudden go up because the stock price goes down, the dividend stays the same, and there's some decent high yields. And of course, that's where people will go when they decide to put more risk on the table. The big funds and stuff, when money starts flowing back in and people start feeling more comfortable, they're going to head to the dividend stocks, they're going to head to the higher growth stocks rather than the fancy stocks, so to speak. Right, number 3, hunt for stocks in different sectors. Common strategy, this one, guys. If you're going in for the high ticket luxury goods, they're the ones that are going to get hammered the most because they know that's where people just pull in the belt and don't purchase those kind of things. But if you're going in for other stuff in defensive stocks or in bellwether stuff that's constantly doing okay, utilities, these sort of plodding stocks, then those are the ones that even though they get beaten down, they're still going to make money. People still pay their water bills and still consume water. Yes, there might be slight differences here and there, but it's not the same as buying, say, luxury vehicles. So check out that one. Okay, number 4, I'll be careful with margin. This is now the number one thing I think people get trapped with, is buying on margin and having so much of a big position that they end up getting hammered out of it. If you're looking to buy and you're holding and you're not talking about short-term trading, you've got to be very careful with margin, because it's going to amplify your error. If you're wrong by a couple of months and that thing goes down by another 20-30%, easily can do, even if you perceive it's low value, just some extra little flush, and you're on heavy margin, you're going to get stopped out of the position. So not only are you going to lose the money, but you're going to lose the opportunity as well. So just watch out for that margin. Go in small, go in without margin if possible. Okay, number 5, consider some shorts or inverse ETFs. I know I mentioned that at the beginning of the video, but I put it on here now because I think a lot of people don't really think about it, even if you're an investor. And if you're an investor, obviously short selling, perhaps don't want to do it, but inverse ETFs, you can buy an inverse ETF, which is almost the same as going short. And all it does is kind of hedge you a little bit. So if you think you've got, example would be, market's just been hammering down to the lows, you think you've got a good place to buy, you've selected 5 to 10 stocks that you'd like to purchase, dividends, whatever. You spread your risk, you've got a plan. By doing that and also adding some inverse ETF means that if you're lucky enough to catch the bottom, then those stocks are going to rise, the inverse ETF is going to lose money because it's going to fall, and you'll be neutral. But those stocks, if they're well picked, should outperform the whole market. But more importantly, and then you can start to peel off that hedge when you feel like the dust has settled a bit. But more importantly, if the market keeps hammering to lows, the good thing is you're making money on that inverse ETF, because that's increasing in value as the market goes to lows. And then you can start to peel off that hedge even lower and use that profit, so to speak, to put in to reduce your overall average price of those 5 stocks you bought. So you can play around with it a little bit. It's not for everybody that, but it's just something to perhaps consider. And the final thing as well to perhaps consider is to buy some call options. Now, call options are capped risk. So if you say, okay, I'm going to buy a well out of the money call option, or I'm going to buy it out of the money call, or whatever it may, doesn't really matter where the position of the strike price is. The point is, if you're buying a call option, you can't lose more than you've put into you've bought the option for. So the beauty of call options is that, let's say that the price is rolling lower and you've bought a call option here for a kind of 1 year expiry. The price can go almost down to a 90% lower. If it then comes back up and makes money for you, you still make money. If it does it in the time period, even though that option will be almost worthless at that point, you're not stopped out. So that allows you to play without getting stopped out. Whereas if you were playing on a CFD and a margin, you had your stop there, you're out of the game. You've crystallized that loss. Whereas a call option doesn't actually, crystallize the loss, so to speak, until it hits expiry, even though the value of the option might well be way, way lower than you bought it for. So that's one way of staying in. If you think that, hey, I'm struggling to time this stuff, let me buy some call options. Let me buy call options of stocks I like, or the ETFs, or whatever it may be. And then I know that even if I'm wrong, we have 6 months more brutal downside, I'm still in until however many months out I've got this 6 months out, 12 months out, 18 months out, whatever it may be. So some things to consider, guys, buying stocks in a bear market. Stay tuned for the next video where we talk about buying in a bear market, not necessarily stocks. See you in the next one. Bye-bye.